But to move on, so this is a question from James. He says, congratulations. It's so rewarding to see your process, which is repeatable and unique, create alpha. And earlier in your presentation, you mentioned that the S&P 500 has performed very, very well beyond its historical performance, and that you expect that performance and growth to slow, as you were just talking about, and for your fund to outperform. Could you just talk about more about why you see that dichotomy happening? Why will the S&P slow down while the Peterson fund outperforms?
Yeah. So the S&P 500 has been this formidable competitor over the last year, or last, I should say, 10 years. I don't think, every year the talking heads are sort of commenting on how the S&P can't continue at this pace, and then it goes up another 17%. And it is just, it's actually quite difficult for value fund managers. It's been very difficult for people to keep up. And the S&P 500 is actually driven by a few large positions. So a bunch of the FANGs are in the S&P, and they're actually great businesses, and they've pulled it up considerably. But if you look at the data, so Jeremy Siegel, who's the chair of the Wharton School, has put together data in his book Stocks for the Long Run, and he analyzes stock data from 1801 until today. And in fact, he analyzes not only stock data. I have this slide I'm going to share here, if I can share it easily. He analyzes, let's see, am I going to be able to? Sorry, I don't want to take too much time trying to share something, but he analyzes you can see this, Danielle. So here's an image that I think it's worth understanding. This is data. This is from his book Stocks for the Long Run, and it's really consistent. He talks about it for a couple chapters. 1801 to 2001, stocks. This is logarithmic scale, of course. Stocks are growing. First of all, it's notable that they're the best performing asset class in orders of magnitude. So the dollar over 200 years becomes worth 6 cents because there's inflation. Gold is worth just under $2. So gold is a nice hedge at times, but really it's not a good investment. Bills are at 300. Bonds, a dollar grows to 1,000. Stocks, it grows to 755,000. It's just enormous. I mean, these entities are designed to organize and build capital, and it's working. In his analysis, what he has found is very consistently the average is 6.8 plus inflation. So an after inflation return of 6.8 is about what you would expect to get if you're in a broad index like the S&P 500. So if you have a situation where the S&P 500 for 10 years has returned 17% annualized, we are just so far, we're in such an outlier category that I am really confident that this time is not different. We will likely have still average 6.8 plus inflation. So, we haven't had any much inflation over the last 10 years either. So this has been a really true outlier, and I'm really confident that it will we'll have reversion to the mean in this scenario. Again, the reason I'm saying that we can perform better and will outperform is that the positions that we hold are growing a lot faster than that. And ultimately, because our businesses are growing faster than that, the stock price, I don't know what the price will do in the short term. I don't really know what it will do over a month or quarter, even a year sometimes. But in the long term, the price of the stock will reflect the value of the business. And the value of our businesses are compounding at very high rates of return. And so the stock price is likely to follow. And if we see an overall slowdown in the growth in the S&P 500, which I would expect over the next decade, it doesn't necessarily impact our holdings, and our holdings can end up outperforming by even a wider margin. when the S&P isn't doing so well. So James, hopefully that answered your question.